Hello everyone, I'm Nandini and I'm thrilled to have you here on the Bond to Win YouTube channel. Today, we're diving into the fascinating world of bonds. You all loved the PDF I shared on Telegram, so let's break it down. Understanding the types of bonds can help you make a better understanding of the concept. So, let's explore how each type can fit into your financial strategy.
Bonds are essentially loans that you give to entities like the government or companies, and in return, they pay you interest. There are several types of bonds used in India. First, we have government securities. These are super safe, like the 10-year Indian government bonds. Then, gilt-edged bonds are also government bonds, but they're considered even safer. Corporate bonds are issued by companies. Think of big names like Tata or Reliance. Next up, municipal bonds are issued by local governments for public projects. Tax-free bonds are a great option for investors looking to save on taxes. Convertible bonds can be turned into shares later, while zero-coupon bonds don't pay interest until maturity. Green bonds fund eco-friendly projects, and sovereign gold bonds let you invest in gold without physical storage. Perpetual bonds don't have a maturity date, while junk bonds offer high returns but come with high risk. Floating rate bonds have interest rates that change, and inflation-indexed bonds protect your investment against inflation. Callable bonds can be redeemed early by the issuer, and finally, capital gain bonds help you save taxes on capital gains. Understanding these can help you make smarter investment choices. Government securities, or bonds, are like loans you give to the government. When you buy a bond, you are essentially lending money to the government, and in return, they promise to pay you back with interest. For example, India recently issued the 10-year government bond at a rate of around 7.2%. This means if you invest 10,000 rupees, you'll earn interest over the years, and after 10 years, you'll get your 10,000 rupee back. These bonds are considered safe investments because they're backed by the government. They can be a great way for students to start investing early, especially with the recent rise in interest rates. Plus, they help fund public projects like roads and schools. So, investing in government bonds not only grows your money but also contributes to the nation's development. It's a win-win. Gilt-edged bonds are essentially government securities that are considered very safe investments. In India, these bonds are issued by the Reserve Bank of India and are backed by the government, which means they have a low risk of default. For students, think of them as a secure way to earn interest on your money. For instance, the recent issuance of the 10-year government bonds offers an attractive interest rate, making it a popular choice among investors. These bonds are ideal for those looking to save for long-term goals, like education or a future home. Investing in gilt-edged bonds not only helps you grow your savings but also contributes to national development, as the funds are often used for infrastructure projects. So, if you want a safe and reliable investment option, gilt-edged bonds could be the way to go. Corporate bonds are essentially loans that investors give to companies in exchange for periodic interest payments and the return of the bond's face value at maturity. In India, companies like Tata and Reliance frequently issue these bonds to raise capital for expansion or projects. For instance, in 2023, Tata Power raised 1,000 crores rupees through bonds to fund renewable energy initiatives. Investing in corporate bonds can be a safer option compared to stocks, as they typically offer fixed returns. However, it's crucial to assess the company's credit rating. A higher rating indicates lower risk. For students, understanding corporate bonds can open doors to smart investment strategies, helping you build wealth over time. So, keep an eye on the market and consider how these bonds can fit into your financial future. Convertible bonds are a unique investment option that combines features of both bonds and stocks. Imagine you invest in a bond that pays interest, but you also have the option to convert it into shares of the company later. For instance, in India, companies like Tata Motors and Infosys have issued convertible bonds recently. Let's say you buy a convertible bond from Tata Motors for 1,000 rupees. It pays you 5% interest annually. If the company's stock price rises significantly, you can convert your bond into shares, potentially earning much more than just the interest. This way, you get the safety of a bond and the growth potential of stocks. It's a smart choice for students looking to understand the market dynamics while balancing risk and reward. Zero-coupon bonds are a unique investment option that can be quite beneficial. Unlike traditional bonds, these don't pay periodic interest. Instead, you buy them at a discount and receive the full face value at maturity. For example, if a zero-coupon bond has a face value of 1000 rupees, you might buy it for 700 rupees. The difference, 300 rupees, is your profit, which you earn when the bond matures. These bonds are great for long-term goals, like funding education or buying a house. They're less risky since you know exactly how much you'll get back. Plus, they're easy to understand and manage. Just remember, the longer you hold them, the more they can grow. So, if you are looking for a smart way to invest, zero-coupon bonds might just be the right choice for you. Inflation-indexed bonds are a smart way to protect your money from rising prices. Imagine you invest in a bond worth 10,000 rupees and it offers a 3% interest rate. If inflation rises to 6%, your bond's value adjusts. So, instead of just earning 300 rupees, your interest now increases to 600 rupees. In India, the Government of India introduced the Inflation-Indexed National Savings Certificate, which helps safeguard your savings. For students, this means your money grows even when prices go up, ensuring you can afford that new laptop or college fees. In 2022, inflation hit around 7%, making these bonds even more attractive. They're a great way to ensure your savings keep pace with the cost of living. So, if you want your money to work for you, consider inflation-indexed bonds. Masala bonds are a fascinating way for Indian companies to raise funds in foreign markets, specifically in rupees. Imagine a company like the Indian Renewable Energy Development Agency issuing masala bonds to finance solar projects. This allows them to tap into international investors while reducing currency risk. For instance, in 2021, the Indian government raised 3,000 crores rupees through masala bonds to boost infrastructure. This means foreign investors can invest in India's growth while earning returns in rupees. The beauty of masala bonds is that they help strengthen our economy and attract global capital, all while making it easier for companies to fund their projects without worrying about exchange rate fluctuations. It's a win-win for everyone involved. Sovereign green bonds are a powerful tool for financing eco-friendly projects. Imagine the Indian government issuing these bonds to raise funds specifically for renewable energy, like solar and wind power. For instance, in 2022, India launched its first sovereign green bond worth 4,000 crores, aimed at funding sustainable initiatives. These bonds work like this: investors buy them, and the government promises to use that money for green projects. This not only helps the environment but also attracts global investors who are keen on sustainability. In 2023, the Indian government issued another green bond to support electric vehicle infrastructure. By investing in these bonds, you are not just earning returns, you are contributing to a greener planet. It's a win-win. Sovereign gold bonds, or SGBs, are a smart way to invest in gold without the hassle of physical storage. When you buy SGBs, you are essentially purchasing gold issued by the government, which means it's secure and backed by the Reserve Bank of India. For example, the current price of gold is around 5,000 rupee per gram. If you invest in one bond, you get 1 gram of gold and you earn an interest of 2.5% per annum on your investment. So, if you invest 50,000 rupees, you'll get 10 grams of gold and an interest of 1,250 rupees every year. Plus, there's no capital gains tax if you hold it until maturity, which is 8 years. This makes SGBs a great option for students looking to grow their savings. It's a win-win: invest in gold, earn interest, and enjoy tax benefits. Public sector bonds are a way for the government to raise money for development projects. Imagine the government needs funds for building schools or hospitals. Instead of just taxing us, they issue bonds. When you buy a bond, you are essentially lending money to the government. For instance, in 2023, the Indian government issued bonds worth 10,000 crores for infrastructure development. If you invest in these bonds, you earn interest, usually around 6 to 7% per year. It's a safe investment because the government backs it. Plus, you get your principal back after a set period, say 10 years. So, while you are helping build the nation, you are also securing your financial future. It's a win-win. Oil bonds are a unique financial tool used by the Indian government to manage fuel prices. Imagine this: when global oil prices rise, the government can issue oil bonds instead of directly increasing fuel prices. These bonds are like IOUs, promising to pay back the amount later. For example, in 2021, the Indian government issued oil bonds worth around 1.34 lakh crore rupees to cover the losses from selling fuel at lower prices. This helps keep petrol and diesel affordable for us, but it also means the government has to pay back these bonds later, often leading to future budget constraints. So, while oil bonds help us save money at the pump today, they can impact government spending tomorrow. It's a balancing act that affects our economy and daily lives. Municipal bonds are like a loan to your city or town, helping fund projects like schools, parks, and roads. When you buy a municipal bond, you are essentially lending money to the government, and in return, you earn interest. For instance, in 2023, the Delhi government issued bonds worth 1,000 crores rupees to improve public transport. This means better buses and metro services for everyone. The interest earned on these bonds is often tax-free, making them attractive for investors. Think of it this way: you are not just investing your money, you are also contributing to your community's growth. So, when you hear about municipal bonds, remember, it's a win-win for both you and your city. High-yield bonds, often called junk bonds, are debt securities that offer higher interest rates because they come with higher risk. In India, the yield on these bonds can range from 8% to 12%, compared to safer government bonds which might give you around 6%. Investors are attracted to junk bonds for the potential of higher returns, but remember, they're rated below investment grade. This means the issuing companies might be struggling financially. For example, in 2023, companies like Vodafone Idea issued junk bonds to raise funds, offering enticing yields to attract investors. So, if you are considering investing in these, do your homework. Look at the company's financial health and market position. High returns can be tempting, but they come with risks. Balance your portfolio wisely. Tax-free bonds are a smart investment option, especially for students looking to grow their savings. Imagine you invest 1 lakh rupees in a tax-free bond with a 6% interest rate. You earn 6,000 rupees every year, and guess what? You don't pay any tax on that income. In India, these bonds are issued by government-backed entities like the National Highways Authority of India. Recently, they launched bonds worth 10,000 crores rupees, attracting many investors. Now, let's break it down. If you hold these bonds for 10 years, you'll receive 60,000 rupees without any tax deductions. This means more money in your pocket for your future plans, like higher studies or starting a business. So, if you are looking for a safe and tax-efficient way to invest, tax-free bonds could be your answer. Floating rate bonds are an interesting investment option. Unlike fixed-rate bonds, their interest payments fluctuate based on market rates. For instance, if the current benchmark rate is 6%, your bond might pay 6.5% for that period. This means when interest rates rise, your returns can increase too, making it a good hedge against inflation. As of now, many floating rate bonds in India are linked to the MCLR, which is around 7.5%. So, if you invest in a bond linked to this rate, your returns could adjust accordingly. This flexibility can be quite beneficial, especially in a changing economic landscape. Just remember, while they can offer higher returns, they also come with risks, so it's essential to do your homework before investing. Callable bonds are a unique investment option that can be quite beneficial. Imagine you buy a bond for 1,000 rupees with a 7% interest rate. Now, if interest rates drop to 5%, the issuer might call back your bond to reissue new ones at a lower rate. This means you lose out on that higher interest. In India, callable bonds are often issued by companies looking to manage their debt efficiently. For instance, in 2023, companies like Reliance and Tata have issued callable bonds, giving them flexibility if market conditions change. So, while callable bonds can offer higher yields initially, always consider the risk of them being called early. It's essential to weigh the pros and cons before investing. Perpetual bonds, or consols, are unique financial instruments that pay interest forever without a maturity date. Imagine investing in a bond that gives you a fixed interest, say 7%, annually for as long as you hold it. In India, with the current interest rates around 6 to 7%, these bonds can be quite attractive. For example, if you invest 1 lakh rupees in a perpetual bond, you could earn 7,000 rupees every year, indefinitely. This means steady income without worrying about when the bond will mature. However, keep in mind, since they don't mature, if interest rates rise, the value of your bond might drop. So, while they offer consistent returns, they come with their own risks. Understanding these can help you make smarter investment choices. Capital gain bonds are a smart way to save on taxes when you sell an asset at a profit. In India, if you sell property or stocks and make a profit, you might face a capital gains tax of up to 30%. But here's the catch: if you invest that profit in specific bonds, like those issued by the National Highways Authority of India, you can save on those taxes. For instance, if you made a profit of 10 lakhs, instead of paying 3 lakhs in tax, you can invest that amount in these bonds for a minimum of 5 years. The current interest rate on these bonds is around 6%, which means your money is still working for you while you save on taxes. So, if you are planning to sell an asset, consider capital gain bonds as a tax-saving strategy. It's a win-win.
So, these are the types of bonds. I hope you clearly understood these concepts. If you have any questions or doubts, feel free to drop them in the comments section. And remember, subscribing to my channel helps you stay updated with more informative content like this.